This is Mark Minervini, born to a family that struggled to make ends meet, a high school dropout who left school in 8th grade with no clear path ahead. He started with nothing but the burning desire to break free from financial struggle. He studied successful people, becoming obsessed with one question: how did they do it? With no college degree, no Wall Street connections, and no formal financial background, he achieved what most consider impossible, turning a small trading account into tens of millions with systematic precision. To be specific, he averaged 220% annual returns for 5 consecutive years, achieving a mind-blowing 33,500% total return. That's insane. In 2021, he proved it wasn't just luck by winning the US Investing Championship again, this time with a 334.8% return. He applied a systematic approach he calls SEPA, Specific Entry Point Analysis, that focuses on buying high and selling even higher. Traditional value investors criticized Minervini for buying expensive stocks with high P/E ratios, calling his method dangerous and unsustainable. But Minervini proved them wrong through his consistent performance and systematic approach. Meanwhile, Mark believed that proper technique combined with disciplined psychology could be taught to anyone. By 2020, 11 of his students ranked in the top 20 of the US Investing Championship. Now, if you're like me, you're thinking, what's his secret? Here's the thing. There's a ton of material about Mark out there. Books, interviews, videos, courses, but most of it is scattered, incomplete, or buried in technical jargon that's hard to follow. I spent days and days going through everything and filtering out the noise. I've condensed decades of his knowledge into this video and I'm giving it to you absolutely free. So if this adds value to your trading journey, hit that like button and drop a thank you in the comments. It really helps the channel grow. Let's get straight to it. Mark says, "My starting point is always to have the wind at my back. That means I only buy stocks that are in long-term uptrend. So catching a wave like a surfer, therefore going with the tide and not against it. It means that you only look for entries in the stage 2 portion of a chart cycle, the green area we see here. Mark says during the other 3 stages, 1, 3, and 4, you are either losing money or losing time." Minervini discovered through studying thousands of winning stocks that 95% of the biggest gainers made the majority of their profits while in stage 2 uptrends. This isn't opinion, it's statistical fact. The best time to buy a stock is when it's making new highs, not when it's cheap. Let me show you exactly how this works with his famous stage analysis. Every stock goes through 4 predictable stages, and Minervini only buys in stage 2. Stage 1 is the neglect phase, sideways consolidation where the stock builds a foundation. Stage 2 is the advancing phase. This is where all the money is made. The stock breaks out and trends higher with institutional accumulation. Stock 3 is the topping phase, volatile distribution where smart money exits. Stage 4 is the declining phase, where most retail investors lose everything. Here's where most traders get it completely wrong. They see a stock that's dropped 50% and think, what a bargain! But Minervini proved this thinking is a recipe for disaster. Instead, he looks for stocks that have a strong run higher and are building what he calls a volatility contraction pattern near their highs. The logic behind the volatility contraction pattern, or VCP, is surprisingly intuitive. Imagine a stock that has already made a strong run higher. At some point, it pauses, and instead of continuing to surge, it begins to move sideways, consolidating its gains. What's important is how this consolidation unfolds. The first pullback is usually the widest. Price might retrace around 20 to 25%. Then, as the stock stabilizes, the next decline becomes noticeably smaller, maybe around 12 to 15%. A third contraction follows, often limited to single digits. Eventually, pullbacks shrink to just 4 or 5% before buyers step in again. Each time this happens, price swings become tighter and tighter. At the same time, trading volume often fades. This combination sends a clear message to the market. Selling pressure is being absorbed. From a behavioral standpoint, it makes sense. Early profit takers have already exited. Weak holders have been pushed out during the larger pullbacks. What remains are more confident investors who believe in the stock and are willing to hold through minor fluctuations. As volatility compresses and volume dries up, the balance between supply and demand quietly shifts. By the time price approaches the upper end of its consolidation range, most of the available supply has already been consumed. When price finally breaks above that range and volume returns, the move can be powerful. Demand overwhelms supply, and the stock often enters a new phase of acceleration. Many of the strongest historical winners showed this behavior before their biggest runs. In Minervini's words, learning to correctly identify a true VCP is essential because nearly all of his favorite chart patterns are built around one idea: volatility should contract before a major expansion. Let me show you how this works with a real example. This stock exhibited the classic VCP signature. The initial pullback created a 28% range from peak to trough. The second contraction narrowed to just 16%. By the third pullback, volatility had compressed to a mere 6%. This final consolidation zone became the launching pad for the next major move. Notice how the tightest price action occurred right before the breakout. This is what Minervini called the pivot point. What makes this pattern so reliable is the volume story. As price volatility contracts, trading volume typically decreases. This creates a state of equilibrium where selling pressure has essentially evaporated. When demand finally exceeds this diminished supply, you get explosive results. In this particular example, the breakout led to a 465% gain over the following 10 months. Another powerful case study involves Netflix. While the market was still recovering from the financial crisis, Netflix was doing something extraordinary. Notice how the stock had already advanced significantly, then began building this tight consolidation pattern. Most traders would say, "This is too expensive, I'll wait for a pullback." But Minervini recognized this as an institutional accumulation. The VCP shows three distinct contractions. First 15%, then 10%, then just 5%. Each pullback gets smaller while the stock holds near its highs. This tightening action indicates that supply is drying up, while demand remains strong. It's like a coiled spring building pressure for the next explosive move. But here's the psychological challenge. You must be comfortable buying stocks at or near their 52-week highs. This goes against every human instinct. Most people want to buy cheap stocks, thinking they're getting a bargain. But as Minervini says, there's usually a good reason why a stock is cheap. The real money is made by buying the strongest stocks in the strongest sectors during the strongest market conditions. Now let's examine Minervini's three-step process: finding the optimal entry point, setting protective stops to limit risk, and determining the perfect exit strategy to maximize returns. But first, I want to thank our amazing community. We selected the user who helped another community member, and we're gifting them 1 free month of Flux Charts, because that's how a community should work, by helping each other out. Please reach out to our email to claim your free subscription. Now, if you haven't heard about Flux Charts yet, this is the platform I use every single day for my trades. It completely changed how I trade. Flux can run screeners on up to 15 tickers and timeframes at once, so instead of flipping through charts, it tells me exactly where my setups are happening. They have backtesting tools to build custom strategies and test them against years of market data in seconds, so you know if a strategy works before risking any money. Here's the best part. 90% of their indicators are completely free. Plus, you can use Flux Charts even with the free version of TradingView, which is huge because you can use multiple indicators simultaneously, avoiding TradingView's 2-indicator limit. They also host daily live trading classes teaching strategies, risk management, and trading mindset. Can't join live? They have a full library of recordings. Click the link in my description and use this code to discover the fantastic promotion I got for our community. Alright, let's get back to the video. First, we need his trend template. This filters for stocks in confirmed stage 2 uptrends. The stock must be above its 150-day and 200-day moving averages, the 150-day above the 200-day, the 200-day trending upward for at least 4 months, current price within 25% of 52-week highs, relative strength rating above 70, preferably 80s or 90s. This template immediately eliminates 90% of stocks from consideration. You only want the market leaders. Next, we look for the VCP pattern. The entry signal comes when the stock breaks above the VCP on volume surge, typically 40 to 50% above average. This confirms institutional participation in the breakout. Stop loss goes just below the final contraction low, usually 7 to 8% from entry. This gives enough room for normal fluctuation while strictly controlling downside risk. Mark emphasizes the importance of capital preservation. The numbers in this table explain why cutting losses quickly is the cornerstone of successful trading. A modest 10% loss requires just an 11% gain to break even, but let a position deteriorate to a 50% loss and you'll need a massive 100% gain just to get back to square one. This asymmetric relationship between losses and recovery gains explains everything. Small losses are easily overcome with your next winner. Large losses, however, create a mathematical prison that can take months or even years to escape. The psychological impact is equally devastating. After a 50% loss, traders often become desperate, taking excessive risks to get even quickly. This typically leads to even larger losses, creating a downward spiral that destroys accounts. By keeping losses small and controlled, Minervini maintained the flexibility to capitalize on opportunities. This is why he says, not losing big is the single most important factor for winning big. Concerning the position sizing, Minervini never risks more than 1 to 2% of his total account on any single trade. Here's how it works in practice. Let's say you have a $100,000 account and you want to risk 1% per trade. That means your maximum loss on any position is $1,000. If you find a stock breaking out at $50 with a stop loss at $46, your risk per share is $4. To stay within your 1% rule, you can buy a maximum of 250 shares. $1,000 divided by $4 equals 250 shares. This might seem overly conservative, but it's what allows Minervini to survive losing streaks and stay in the game long enough for his winners to compound. Remember, he expects to lose on 60 to 70% of his trades. Without proper position sizing, a few bad trades in a row could wipe out months of gains. The math is simple but powerful. If you risk 1% per trade and lose 10 trades in a row, you're down about 10%. Painful but survivable. If you risk 10% per trade and lose 3 in a row, you've lost 27% of your account and need a 37% gain just to break even. Now here's his selling strategy. When the stock moves in his favor, he doesn't just hope and hold, he uses trailing stop loss. The stop loss can be moved up when the stock rises by 2 or 3 times the initial risk, and profits should be locked in when the trend changes. This is often referred to as the trailing stop. Imagine you enter a position with $1,000 at risk. After 20 weeks, your investment has grown to show a $2,000 profit. At this point, Minervini would adjust his stop loss upward to protect gains. This new stop gets positioned at a logical support level, perhaps near the 200-day moving average where institutional support typically emerges. This adjustment locks in approximately $1,000 of profit while still allowing room for the uptrend to continue. As the stock advances further, you repeat this process. Each significant move higher triggers another stop adjustment, systematically protecting more profits. The key is moving the stop to meaningful technical levels that respect the stock's natural rhythm. This continues until the trend finally breaks. When that happens, often signaled by a decisive close below a major moving average like the 200-day, it's time to exit completely. If your trailing stops haven't already triggered, this breakdown serves as your final exit signal. The beauty of this system is psychological as much as tactical. By progressively locking in profits, you remove the emotional pressure of watching gains evaporate. You can let the winners run without the fear of giving back everything, while still capturing the majority of major moves. But here's the crucial insight most traders miss. Minervini expects to lose on 60 to 70% of his trades. His edge comes from massive winners that more than compensate for small, controlled losses. This simple chart explains how you can lose on 70% of your trades and still make millions. While others chased high win rates, Minervini built his fortune understanding these probabilities. The mathematics are simple. Lose 8% 7 times equals minus 56%. Win 100% 3 times equals plus 300%. Net result, plus 244%. What about fundamentals? Minervini looks for 3 key accelerating metrics: earnings growth, preferably 25% plus and accelerating; sales growth, showing the business is expanding; net profit margins, indicating operational efficiency. The magic happens when all 3 accelerate simultaneously, what he calls the Big Three. This creates massive institutional pressure that drives super performance. Now let's recap everything we've learned about Minervini's legendary approach. Only trade during Stage 2 market uptrends. Screen for stocks meeting the trend template. Identify VCP patterns with proper volume characteristics. Enter on breakdown with volume confirmation. Set 7 to 8% stop loss below base. Manage position using trailing stops. Take profits into strength on extended moves. The psychological requirements: comfort buying stocks at new highs, discipline to cut losses quickly, patience to let winners run, ability to go against crowd sentiment. Mark Minervini proves that systematic approach combined with proper psychology can generate extraordinary returns consistently. His 33,500% return over 5 years isn't luck. It's the result of mastering a proven methodology and executing it with machine-like precision. Thank you all for your support, and see you guys next time.